The yield curve inversion. What is it telling us? 50% of the people say, look, it's the end of the world, impending recession. The others saying, look, in the last 10 years, everything's changed, so don't worry about it.
It's basically telling us, pay attention. Okay. That the market is increasingly concerned that the Fed will make a policy mistake, and the markets are accordingly say, just pay attention.
Okay, pay attention. Do you worry that a 50 basis point hike from the Fed is actually the wrong message because it suggests panic and too many questions about what happens next?
Look, I worry that we're in a no-win situation. I worry that the Fed now has to choose between one of two mistakes and has to decide which one it would rather make.
Okay.
Go too fast or go too slow. I would go too slow. That's a mistake I would make. But I understand that a Fed that has lost credibility may want to go too fast.
Okay, but because, what do you worry about? That if they go too fast and they have to reverse it, which is what we've seen in Europe about 10 years ago?
I worry that they'll tip us into recession. That's what I worry about. That they are late, that they mischaracterized inflation for too long, they didn't do enough, and now they feel that to regain their credibility, they have to show, and they hike twice by 50 basis points.
Yeah, Mohamed, Dani also has a couple of questions for you.
Yeah, Mohamed, good morning to you. Thanks so much for joining the program. And you've been very clear of your fears over recession. Earlier this month, you called for the potential of double-digit inflation figures. Does an SBR release from the Biden administration and lower oil prices this morning relieve any of those fears for you?
It helps, but it doesn't remove them. I think that the distribution of outcomes has shifted. Stagflation used to be a risk. It's now a baseline. Goldilocks used to be the right, now has moved to being out completely of the distribution. And in the left tail, recession has come in. I don't think that the release of the oil will significantly change that distribution.
And of course, all of this leads to a market that's very difficult to invest in. We saw it last quarter, stocks, bonds falling 5% or more. You've written a recent Bloomberg opinion column saying that this environment will push investors to private markets. With private markets already $3 trillion or more in dry powder, what does it mean to have a world more awash in private money?
So I made sure to say you also need the private markets to expand their offering. There's a lot of opportunities in developing countries, for example, that remain underexploited. There are other places where people haven't gone as yet. So the private markets are going to have to step up and offer a much broader range of opportunities.
Can you hear the bells, Dani, ringing in the background? It's so very Italian. I mean, we haven't done this in person for quite some time. Mohamed, when we were talking about with Laurence Boone about some of the possible rationing, I mean, we don't really know how to model a complete price shock in oil, right? If tomorrow the taps are turned off because it's not paid in rubles, because one side says, right, that's it, what happens to the world economy?
So I think Europe goes into recession. It's almost a certainty that Europe goes into recession. I think the rest of the world has a massive stagflationary wind. And what we don't talk about enough, Francine, is the commodity importers, developing countries. They lack self-resilient, and I really worry about them.
Meaning possible default, or meaning how ugly could it get for them?
It can get really ugly. Don't forget the phrase that Kristalina Georgieva, who you know well, said, war in Ukraine could equal famine in Europe, in Africa.
Yeah, because of course they do so much of the wheat and the flour. Is there anything that governments can do? So we talk about, and I don't know, the markets have not really clocked on to this idea of rationing, whether it be energy prices, or is that what we'll have if this war doesn't stop soon?
Yes, if the war doesn't stop soon, you're going to have not just higher commodity prices, you're going to have significant supply disruptions. Remember what you and I will do in a world like that. We will stockpile. So what you get is lower supply, higher demand coming at the same time.
What does that mean for the market? I mean, the markets at the moment, I feel like they have blinkers, right? They're saying, I'll be fine, we'll work through it. Is that going to lead to a huge correction?
I don't think they have blinkers. I think they're living in a relative world. So if you're an equity investor and you're taking on a lot of risk and you want to move, where do you go to? Cash, guaranteed negative real return,
yep.
Bonds, capital depreciation, where do you go? So they're thinking in a relative space. What you're talking about would shift us into absolute space, and that's a different proposition.
Well, I mean, do you see that at some point, them going to cash because of the absolute space? I mean, if we're talking about rationing, I mean, this, we haven't, none of this is modeled. This is not priced in anywhere, really.
So I have an article coming out in the Financial Times on Monday that says exactly this. Says this is the time to take some chips off the table. The market has been incredibly resilient, and investors should take advantage of that.